In macroeconomic news, the U.S. stock market sailed into the weekend on a euphoric note, with major indices reaching record highs, fueled by rising tech stocks and falling inflationary pressures. Key economic indicators, such as the Personal Consumption Expenditures Price Index and the Employment Cost Index, have shown signs of moderation, aligning with the Federal Reserve's resolute efforts to combat the recent surge in inflation. Additionally, the stock market sentiment was further influenced by Johnson & Johnson's ongoing legal battle and intriguing developments in the real estate market, which we will talk about later in the video. The latest data release on the Personal Consumption Expenditures Price Index brought a sigh of relief to investors as it grew by a mere 3% last month compared to last year. This modest increase marked the lowest annual rise since 2021 and signaled potential progress in taming inflation, which has been a primary concern for the Federal Reserve. The Bureau of Labor Statistics also added to the optimism, reporting that the Employment Cost Index rose at its slowest rate in 2 years, indicating potential stabilization in wage pressures. Federal Reserve Chairman Jerome Powell reaffirmed the central bank's commitment to containing inflation, stating that policymakers would closely scrutinize economic data to decide on further rate increases in the upcoming months. These latest indicators bolster the possibility of gradual monetary tightening by the Fed, aiming to strike a balance between curbing inflation and sustaining economic growth. In a dramatic turn of events, for the second time, a bankruptcy court has rejected Johnson & Johnson's efforts to resolve the 38,000 lawsuits claiming its iconic baby powder causes cancer. The court's decision puts the $8.9 billion deal that the company had previously struck in jeopardy, potentially exposing the pharmaceutical giant to further legal proceedings and financial liabilities. Judge Michael Kaplan, presiding over the case, ruled that Johnson & Johnson did not have justifiable cause to seek resolution through the bankruptcy system instead of addressing the cases through conventional legal channels. This raises questions about the company's intentions in pursuing bankruptcy protection. Johnson & Johnson has vowed to appeal the court's decision, setting the stage for further legal drama. The U.S. housing market has experienced a paradigm shift in buyer preferences, driven by the Federal Reserve's sustained efforts to raise interest rates. Older homes with higher repair and energy costs have lost some of their allure, making newer homes more appealing to buyers. Aiming to curb inflation, the Federal Reserve's aggressive rate hikes have pushed the average 30-year mortgage rate to 6.81%, more than double its lowest point during the pandemic. As a result, current homeowners who secured mortgages at historically low rates are now wary of selling their properties and acquiring new ones with significantly higher mortgage costs. This reluctance has led to a shortage of pre-owned homes on the market, causing a mismatch between housing supply and the demand from aspiring home buyers. However, some developers have spotted an opportunity and are prepared to swoop in with more affordable homes tailored to first-time buyers. Housing construction has also begun to recover from the steep decline experienced in the previous year, promising a potential solution to the real estate conundrum. The Federal Reserve's chairman, Jerome Powell, and the entire Federal Open Market Committee, FOMC, have been resolute in their mission to combat surging inflation. The ongoing inflation surge has impacted various sectors of the economy, including transportation, hospitality, and dining, leading to concerns about rising prices for consumers and businesses alike. The FOMC's response has been a series of interest rate hikes, bringing the benchmark rate to 5.5%, its highest level in over 22 years. Powell and his colleagues hope that raising borrowing costs will reduce overall economic activity, leading to slack in demand and eventually tempering inflationary pressures. Though the higher interest rates may come with short-term costs for consumers and businesses, the Federal Reserve deems them necessary to target inflation and stabilize prices in the long run. As interest rates rise, consumers can expect higher credit card interest rates, increased auto loan rates, and elevated mortgage rates. For those seeking new credit, the higher rates may lead to rejections, as lenders aim to mitigate potential risks in a higher interest rate environment. This economic trade-off is considered necessary to tackle inflation and prevent a scenario where high inflation becomes entrenched, making it difficult to control. On the business front, the higher interest rates translate to increased borrowing costs, making it more challenging for companies to expand operations, hire new employees, or invest in new ventures. For businesses already grappling with supply chain disruptions and labor shortages, the impact of higher interest rates may further compound operational challenges. The Federal Reserve remains steadfast in its commitment to restoring price stability and containing inflation. Chairman Powell has acknowledged the difficult choices faced by the central bank, but remains focused on wrestling down price increases to ensure a strong labor market over time. The Fed aims to achieve year-over-year price increases at around 2%, a target it has yet to fully attain. As the U.S. economy continues its journey towards recovery, the Federal Reserve's policy decisions and their impact on inflation, interest rates, and overall economic activity will be critical factors shaping the trajectory of financial markets and economic prosperity in the months to come. In microeconomic news, we have Threads, the new app launched by Meta, may not be the Twitter killer that Mark Zuckerberg had envisioned. According to a report from Reuters, the app experienced a rapid influx of users initially, but it has since lost more than half of its signups. Despite this drop-off, the Meta CEO assured employees during a company town hall that the attrition was actually less than expected, expressing optimism that user retention would improve as new features are introduced to the app. However, the uncertainty surrounding the much-hyped showdown between Zuckerberg and Elon Musk adds to the challenges facing Threads in its competition against other social media giants. In another notable development, Elon Musk disclosed that X, formerly known as Twitter, currently boasts an impressive 541.5 million monthly active users. The rebrand of X, initiated by Elon Musk himself, seems to have attracted significant interest and engagement. Meanwhile, Tesla is actively exploring opportunities in India, with 2 senior executives meeting officials from the country's investment promotion arm to discuss the company's plans for market entry. Additionally, Advanced Micro Devices announced a substantial investment of approximately $400 million to expand its presence in India over the next 5 years. Amidst all this news, Trader Joe's faced a concerning situation with its fully cooked falafel, leading to the issuance of a third product recall in a single week. The recall was due to the falafel containing rocks, so consumers should be aware of this development. Lastly, it's natural to wonder how increasing the cost of monthly credit payments, as the Federal Reserve has been doing, would help bring down the price of goods and services in the economy. This apparent contradiction stems from the Federal Reserve's efforts to combat surging inflation by curbing economic activity through higher interest rates. By reducing borrowing and spending, the Fed hopes to create a slowdown in demand, which could eventually help alleviate inflationary pressures. As financial professionals closely monitor these developments, uncertainties surrounding app adoption, global market dynamics, and monetary policies continue to shape investment decisions and strategies in an ever-evolving financial landscape. With that said, I wish you happy investing.